Welcome to Stocks in Translation, broadcasting from the New York Stock Exchange. I'm Jared Blickery, your host, and with me is Yahoo Finance's Alexandra Canal, in for the People's Voice, who's on assignment. First, please like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today we are welcoming Michael Gapin. He is a U.S. chief economist at Morgan Stanley, and it's great to finally have you here. Today, we're going to be talking about the ever-evolving tariff landscape and the U.S. economy in general. Our phrase of the day is asset price shock, why investors are watching the wrong bouncing ball, who really decides the fate of this economic expansion. And this episode is brought to you by the number 1944. It's a level traders are watching in the Russell 2000, but today, for this discussion, it is the year the world rewrote the monetary rules. Is 2025 our next reset? So, Michael, it's a big day for the world. We were calling it President Trump is calling it Liberation Day. We have no idea what's going to happen after the bell today, but we're going to talk about a bunch of different things. Just bring us up to speed on what you think of how things have evolved with the Trump administration and global U.S. economics so far.
I think we've seen a shift in sentiment, right? What started out as, I think, optimism about, let's call it a lot of good things. You're going to get all the positive elements of the growth agenda. But I think that was quickly replaced by concerns and worries about a much more expansive tariff agenda than I think markets were thinking about. And immigration controls, I think, which we all expected, right? The two of those things together have made markets think about stagflation, not literally, right? Not literally.
Not capital S, maybe lowercase.
That's right, a little lowercase. So the slower growth, the stickier inflation. So we had a very rapid shift from what we thought was maybe over-optimism to a little more reality, if not even pessimism. So I think it's been a very fast and furious open for the Trump administration. Changes have come fast and furious, and I think that has weighed on sentiment.
And to that point, like you were saying, we've really seen a big focus on tariffs and a little bit the immigration side, but tax cuts, deregulation, some of those things that Wall Street really cheered after his election, that's sort of been put on the back burner. Do you think once we get that, will that be enough to sort of offset some of this tariff pain?
Probably not. I mean, you're right that there was a lot of optimism around that, and our argument was those are the slower moving parts of the agenda. It takes years to re-regulate the economy, and it will at least take, we think, most of this year to do the fiscal bill. So it's possible you get some offset from that, but deregulation is probably a sector story. It's probably more about energy and finance, not so much a macro story. And I think they will find it challenging to expand the deficit. I think where they will likely end up is keeping fiscal policy broadly unchanged. And so on net, it's something we think will still lead to slower growth. But there's possible, we don't know. We'll have to see how that agenda evolves. But I think what's key is it's more of a 2026 and beyond story. Tariffs and immigration should weigh on the economy this year.
All right, we want to get to our phrase of the day, which is asset price shock. So this is a sudden drop in the value of assets like stocks, bonds, or real estate that can ripple through the economy and hurt spending, especially by wealthier households. And that wealthier households, that's kind of the key part, because in your notes to us, you're saying that investors are too focused on spending by the lower income bracket. Just kind of unravel this for us.
Yeah, so coming out of the pandemic, there was the whole excess saving argument, the revenge spending. And I think there was concern that when that excess saving ran out and inflation was still high, would there be pressure on lower and middle income balance sheets in a way that caused the economy to tip perhaps into recession? And our argument is that's the wrong way to think about it, that the real risk, as you mentioned, is an asset price shock. Because upper income households, we're talking about roughly the top 20% of income earning households, sit on a majority of the wealth, and they also account for 40 to 50% of total spending. So I think what stands out right now in the U.S. economy is still the level of its asset prices. It's not a leverage bubble. It's not an overinvestment cycle. So I think the real risk is if the noise and uncertainty around trade policy causes equity valuations to fall, does that upper income household say, maybe we should spend a little less and save more And I think that's the catalyst for a broader slowdown.
And I'm curious, you're an economist, so do you look at the stock market very closely? I feel like it's very intertwined right now, as you were just mentioning, because there's this ripple effect. If the wealthy income consumer has been holding up this economy, and then they're seeing their stock portfolio tank, they're going to pull back, stop spending, that leads to that ripple growth that you were mentioning. So how closely are you watching stocks now? And is that out of the norm?
So the way you encapsulate it is the right way, I think, for an economist to look at it. We don't kind of pick winners and losers, this industry over that industry. But in our mind, it's the level of wealth that determines how willing you are to consume out of current income, right? So we're differentiating between wealth and income here. So the higher asset prices are, the more wealthy the economy is, the stronger actual consumption can be, the lower the saving rate is. So what we watch it for is it's like a financial conditions component. If equities go down, it's as if interest rates went higher, you spend less, save more. And this is where we get into, economists love to talk about Keynes's paradox of thrift, right?
Please.
Where
break this down.
If individually you save, it feels virtuous and the right decision. But if we all save, we're in trouble because my spending is your income in the economy. So what feels good individually, if it happens on a broad enough scale, actually creates the
If
downside.
my teenage self could have heard it, I could have said, Mom and Dad, this is good. I need to keep spending.
That's right.
What reports are you looking at that kind of clue you in? What's your canary in the coal mine here? High frequency data, anything in there?
The economic data right now is really noisy, and it happens in these kind of moments where we get kind of shocks to trade and inventory. So the GDP data is really hard to read. I'd honestly say focus on the tried and true employment report. So are we
the monthly one?
The monthly one. Are we adding jobs at a sufficient pace to keep labor market income growing above inflation? If we're not, the economy is going to slow down.
How much longer, though, can this solid labor market support this economy? We've already seen hints of softening.
Right.
We'll see if we get any impact from those Doge layoffs. It hasn't showed up in the hard data yet. But how much more is there?
Well, I think there's less cushion, I think is the way we would phrase it. We're running roughly around 150,000, 160,000 jobs a month recently. That doesn't feel good vis-a-vis where we were.
But historically?
Historically, yes. If you go back to the 10 years after 08, 09, we got about 150,000 jobs a month. We called that a recovery. So it doesn't feel great vis-a-vis where we were, but I think there's enough cushion where as long as we're adding 100 to 150,000 jobs a month, we'll be okay. The further you start dropping down below 100, you have to question the sustainability.
So you don't even wait for it to go negative. That's the headline payrolls number. What about unemployment and also wage growth? Because we've seen we haven't talked about inflation yet. We've seen tremendous inflationary pressures within the last few years, and right now it just kind of seems sticky. Like we're almost stuck at an unacceptably high, but not too high level.
Right, and so I'm going to wrap in the immigration story into this too, because if we have much slower immigration, which it looks like we will, right, going from 3 million immigrants a year, maybe down closer to 0, that means much less growth in the labor force. So it could even be the case that slower employment growth still coincides with a low unemployment rate and a tight labor market.
And that's a stagflation, lowercase s.
And that feeds into a wage environment that may be above where you think it, quote, should be as a policymaker. And it maps into the tariff story, where growth should slow, probably some firmness or stickiness in inflation, and that's what makes policymaking in this environment hard.
Do you think the immigration story has been buried a little bit?
Yes, I think it's because tariffs are a big, bright, shiny object. We get announcements on them frequently, as we all know, and so they drive attention, and they're visible, right? The prices will go up. Tariffs are going on. Immigration, we don't see it in real time, but I think it's just as important in terms of your view on the outlook as tariffs are.
What do you think? How do you think investors should be looking at this? And I know you're not looking at this through a markets lens; it's an economist lens. But just generally, how should people living their ordinary lives who want to invest? What should they be thinking about?
Well, so we're in a period of heightened uncertainty, right? So there's probably more potential paths for the economy than we've had in a while. And so I think what that means is diversification is important. We still think the economy will grow, just at a slower pace. We're not calling for a recession. So we would say you still want to be involved in the areas that generate return. So, high quality corporates, equities, right? So our strategists would have all the views kind of on where things are. We're not saying don't participate. We're just saying you probably want to balance that with things that'll do well if the world doesn't turn out fine. So cash, short-term treasuries, right? So maybe barbell your exposure that it'll work in different environments. So when there's so many different paths for the economy to go, diversification is your friend.
And what do you think about the Federal Reserve's role in all of this and the Fed put?
Mr. Powell.
Mr. Powell, can
Trump has
he
a put
save
too.
us? Can he save us?
Save is a strong word. It's a really difficult environment for them. Risks on both sides of their mandate lie in the bad direction.
I'm like, I do not
Very
envy
asymmetric,
this.
though.
So threading the needle for them is hard. I think what their intention will be, we'd like to look through any tariff-induced inflation and ease, if necessary, to support activity. The problem is, of course, the tariff-induced inflation comes first. The weakness in activity tends to come later.
Like the chicken or the egg.
So the more we do tariffs and the higher inflation goes in the short run, the more maybe it means the Fed delivers cuts that the market wants, but later. And that's the trick. The timing differential here is tough.
He said the word transitory. This is Jay Powell at the last FOMC conference, and I kind of cringed. I don't know if that was doubling down on something, if it was a misspeak, but I mean, there's a lot of thought that goes into the preparation for these events. I'm just wondering what you think about him using that word again.
Well, he's tried to avoid using it for several years, right? But it's hard to, so they were talking about looking through inflation and things like that. So yeah, we all noted it. And I think the issue is, well, can you really rely on it again? Are we really going to do this again? I think they're right on that. I think the evidence is that tariff-induced inflation is temporary.
He said the textbook says you should look through.
The textbook says you should look through. So I think what he was doing there is essentially trying to communicate, their so-called reaction function. How should you expect us to behave, which is an easing bias, right? He said several times, we're either going to stay where we are or cut, right? So a very asymmetric reaction function there. The hike story is one where it's not transitory, and it actually creates second round effects in services inflation and inflation expectations. They don't expect that, but they need to make sure that that's not happening before they ease, and that's the difficulty. So
But you see how the narrative is going to go.
Yes,
that happens.
that's right. And it was, he kind of got, I don't want to say he got backed into saying transitory, but yeah, you can kind of feel like, we're gonna say this again.
Yeah.
All right.
Panic.
Hold that thought. We need to take a short break. Coming up, we're going to take a look at a new global economic order, plus a runway showdown featuring America's favorite Treasury Secretary. It's Hamilton. This episode is brought to you by the number 1944. That is the year the entire world rewrote the financial rules at Bretton Woods. President Nixon upended it a few decades later by closing the gold window. Half a century later, we are looking at other options, to put it mildly. How do you see this unfolding here?
Yeah, I think the easy answer here is to say we're moving away from the post-World War II arrangement. And I think under a Democratic administration, that would have happened with more gradual drift. The Trump administration is getting us there faster. So I think the direction of travel was there. The question is, I think where you're getting at is, where do we end up? And I think the honest answer is we don't know. But it does feel like there's a lot more, like it's going from a unipolar world to a multipolar world. Maybe back in the old days, we would have called this something like the Monroe Doctrine, right? The spheres of influence, where the major countries in each region kind of take control of their own backyards, right? So the U.S. will take control of the Western Hemisphere, Russia, Europe, China, but it's a world that can be stable, but is certainly more fractured. So it's hard to know exactly where we land, but at least for the moment, that seems to be the direction of travel, right? So I think, simply put, the world is choosing less openness, right? And that's keeping markets on edge.
Yes, and this kind of ties into the Mar-a-Lago Accords, which I was a little late to the game. I was reading it over the weekend, but there's a lot to unpack in there, and it has to do with security guarantees that the U.S. is providing the world, and the cost, according to this document, should be borne by other nations buying our century bonds. That's 100-year bonds, and I don't know how much play this has within the Trump administration, but it seems to have some play here. I'm just wondering how you think about this, and is this just a total upheaval? Is this realistic? Is there a timetable here?
Unclear. Is it realistic? It's probably will not achieve their ultimate goals, right? So if the goal is to reduce the current account deficit, there's a lot of components in the Mar-a-Lago Accord involving coordinated selling and weakening of the dollar, a sovereign wealth fund, as you mentioned, an exchange of shorter-term liquid treasuries for longer-term century bonds. But I think honestly, at the end, if we're not going to take the steps necessary to correct what's driving that current account deficit, which is a large federal deficit, then I'm not convinced you can get there without, the adjustment you really need. Right, so it's an end around the fact that really what you need is some balance in the federal budget.
How do you even get that, though? It just feels like
in the current environment, yes, right.
Every year we continue to believe
Every
in
administration
deficit.
ratchets up the spending regardless of
Right,
party.
and you do have DOGE in theory. That's
well, I mean, we know the answer. You need more revenue and less spending,
Yeah.
right? But the political consensus to get there really difficult to achieve, right? So I think in the end, trying to implement other arrangements, in this case, the components of the Mar-a-Lago Accord, probably don't get you to where you want to be. But they do represent, I think one of your points here is that investors need to consider a much wider range of potential outcomes. So don't just think this is just a tariff story. It
Right.
could evolve into many other components. So I think we need to think more expansive in our potential next steps for policy.
And when we're thinking of expansion and really the relationship between the U.S. and other countries, what are your thoughts about foreign boycotts and how we're starting to see that kind of pop up in the data and the potential drag that could have to GDP? Goldman Sachs has an estimate about 1% to 3%, translates to just over $80 billion hit, modest hit, and compared to where we're at. But do you think that's something that should be a concern right now?
Well, I would wrap that into a broader, it's one thing to choose less openness, it's another thing to choose to be closed, right? And the further you go down we need to be self-sufficient and everybody backs away from trade, then that's a dangerous scenario, right? There's only kind of one period in, call it the modern industrial history of the world, when trade as a share of GDP fell. It's a particularly bad historical time period that nobody likes to reference. So I think that's kind of the risk. The more that the barriers go up in all directions, then it's not just about kind of backing out of the global arrangement. You're moving into a much more restricted trading environment, and then you're talking about, a much more worrisome outcome. We're not there, and I'm not suggesting we're going there. But I think what you're pointing to is the rest of the world won't just kind of sit by idly and wait for us to implement what we're going to implement. You will get responses from other countries along the way, which will complicate the narrative.
The multiple scenarios,
That's
as
right.
you alluded to.
Right.
All right, hold that thought because we're going to continue this conversation into our runway battle. It is a clash of global visions, protectionism versus globalism. Now, starting out first, clad in structured authority and early American ambition, is Alexander Hamilton. If you've seen the musical, you know it's about central banks, national debt, and economic order, the original power suit. But don't blink, here comes Tom Friedman, New York Times columnist and Pulitzer Prize-winning author, gliding in with lightweight fabrics and global threads. His look, it's decentralized, digitized, and deeply interconnected, all tailored for a flat world. The spotlight is on a fraying post-World War II runway. Nations are retreating behind tariffs and fences, and globalism is out. Self-reliance is in. So, is 2025 still Tom Friedman's moment, or is Hamilton making a comeback in bespoke protectionism? Michael, who's wearing the brave new world world best. Not at all loaded.
Not at all loaded. Look, I mean, Hamilton was protectionist in the sense that he did favor higher tariffs to protect U.S. industry when we were at a much earlier stage of development. He was much more globalist on the capital side of the agenda, as you mentioned. So the federalizing of the federal debt, the recognition that if we want to grow as an economy, we need to attract capital. So I think global financial markets and product markets need the same arrangement. So and I'm going to give you a cop-out economist answer.
Okay.
They're both right in this case, meaning you can't have one arrangement for the flow of goods and services and another arrangement for capital, right? It's non-compatible in that regard. Right now, I mean, the horse race in the moment is the protectionist argument's winning, right? So Friedman's losing at the moment, but he continues to write, I think, very compelling articles. If you want to kind of condense the global story into a readable format, I think he's been nailing it as good as anybody right now.
We got a couple minutes left. Love to get your take on anything we haven't touched here, and I'll give you the floor.
Well, I think just the one thing I would say, in referring back to the many potential outcomes story, it's been how many years now? Going back to late 2019, we've been dealing with one major bout of uncertainty after another, and I know investors and markets, everybody wants clarity and certainty. They want resolution to uncertainty. They want uncertainty clearing events. And I think the point is we're living in an environment where that's just not possible and we're not going to get it, right? So the desire for certainty, truth, and the right outcome, we still need to pursue that. But I think you need to sit and feel comfortable in a lot more uncertainty than we've had in a long time.
That sounds great. I wish that would happen.
And it led me to a question that I had coming into this was, what's the threshold of uncertainty?
We got about 30 seconds.
Yeah, the honest answer is we don't know, right? It's something you only know looking in the rearview mirror. The initial response is uncertainty tends to make everybody wait. And so it slows things down and it makes the economy vulnerable to whatever the next shoe is. So I think uncertainty alone is unlikely to do it, but uncertainty puts you in a position where if the next shoe drops, then you can have a problem.
Has the shoe dropped yet, or are we still in this wait and see mode?
10 seconds.
Hasn't dropped yet.
Hasn't dropped yet? Okay, that's all I need to know.
All right, we are winding things down here at Stocks in Translation. Be sure to check out all our other episodes on the Yahoo Finance site or mobile app. We'll see you next time on Stocks in Translation.